What I want to do in this video, hopefully a short one, is illustrate how a monetary economy can be created from scratch by a government producing its own currency, which is one of the essential tenets of modern monetary theory. So I'm just recording my screen here. I hope this is reasonable visuals. And what I'm using is my Minsky software, which is designed for dynamic modeling. And I'll start from a very simple starting point that even Milton Friedman will agree with. I'm going to define the GDP of an economy as being the velocity of money times how rapidly money turns over. This was an essential part of his model of the optimum quantity of money that ushered in monetarism. But I'll just say, let's say money turns over 4 times a year, which is generous. It used to. Now it's down to about less than 1. So say a maximum of 4, a minimum of 0.5, which is close to where it's getting to these days, and a step size of 0.1. So I can vary velocity as I want to. Of course, I've then got to multiply the amount of money in the economy, and I'm just going to start with defining a variable called money without, just give the name. I'm not going to actually define it yet. I'll do that in a moment. And then multiply velocity by the amount of money, and you get GDP. Of course, I'm talking nominal GDP here, but that's what the debate is all over, whether a government can start an economy, monetary economy from scratch. How does fiat actually work? So there's the basic idea. Now, of course, if I try to graph both money and the GDP, I'm going to get 0 right now because there's no money and there's no GDP. So how do we turn this into a system with money and GDP? It's going to take a copy of each of money and GDP here and graph them against this plot. And once I wire it up, of course, I'm going to see absolutely nothing because there's no money and there's therefore no GDP. I run it, bang, flat line. Now, in this model, I'm going to look at a government creating, or rather spending, by putting money in people's bank accounts. And for that, we need a banking system. And Minsky has designed to model the banking system. So this is the banking system. And of course, the essential thing to have in here is deposits. So this is the assets, liabilities, and equity view of financial transactions that Minsky is based on. And if we have deposits as where the public puts the money they have, this is the bank's equity, and I'm just going to be looking at short-term equity here, and I haven't defined an asset yet, but that's my initial conditions: no money in deposits, no bank equity, and the first thing I'm going to look at is government spending. And if the government spends, it spends by crediting people's deposit accounts. So that's the start of trying to find a monetary economy with a government creating its own currency. And in double entry bookkeeping, there have to be 2 entries per row and they must sum to 0. That's what A minus L minus here stands for. Assets minus liabilities equals equity. So on every line, it must be that assets minus liabilities minus equity equals 0. Otherwise, you made an accounting error. So I've got to type spend as an asset, and the asset that matches the increase in the liability for the banking sector we call reserves. And that's the money that the banks have themselves, or the accounts that banks have at the central bank. So there's our basic starting point, a government spending money here, and then I'm going to look at taxation as well. And taxation obviously works in reverse. So tax takes money out of deposit accounts, and it also therefore reduces reserves. Now, having done that much, I've got the absolute basics of trying to define a monetary system. I'm going to drag things around here a bit on screen. And I'm going to take a copy of all the variables in the model. So I'm just copying all the stock variables, that's the bottom 3 here. And then I can copy the flow variables, spend and tax. And they're going to be control variables here. So I'm going to be changing the amount of spending just manually when I run a simulation, changing the amount of tax and seeing what happens. And of course, spending minus tax equals the deficit. So I just type a minus key there in Minsky to, and then I wire up spend to the plus, tax to the minus, pardon me, and the difference is the deficit, which I should spell properly, shouldn't I? So there's the deficit. Okay, and I then wire this together, and what this is saying is spending minus taxation is equal to the deficit, which is obviously correct. And now I want to make it possible to vary spending over time. So I'm going to say, imagine the initial value of spending is 0. It's got a maximum of 100, a minimum of 0, and a step size of 1. And then the same for taxation. So I'm going to give it an initial value of 0, maximum of 100, minimum of 0, and a step size of 1. And then I can vary those just by pressing the up and down arrow key when I'm running a simulation to see what happens and model the system. So that's the basic idea of modeling this in Minsky. And I want to see what happens to our GDP when the government spends and when it then taxes. So I'll go back to seeing this full screen now, and I'll move this around up here. And I want to look at reserves and deposits and equity as well. And I'll just look at those in the little mini spreadsheet. So I just bring one of these spreadsheet widgets down and wire that up to reserves and take a copy of it, since I made it the size I want, and the same for deposits and the same for bank equity, and just wire those up there and see what happens. At the moment I've only got those 3 accounts in the system, so that's all that I can actually model. So we hit stop to clear the simulation, hit run. Of course there's nothing happening here, there's 0 money and 0 GDP, but then if the government spends more than it taxes, what we're doing as a result of that is creating reserves. Let's make the window a bit wider here. We can't, as yet, at the moment with this current version of Minsky, we can't vary the numerical accuracy of these little windows, so I'm stuck with it coming out at 4 digits, but that's life. We'll fix it up in a later release of the software. Nothing happening to bank equity. So bank equity is still 0. Deposits have been created by spending exceeding taxation, and reserves have been created identical to the amount of deposits that have been created. So let's just do that once more and then see what happens to GDP. So now we have this running. We have a rising, I haven't defined money yet, so I've got to just finish that up. So I've got money down here. So what is money? Well, money in this model is going to be the sum of the deposit accounts and the bank equity. This is short-term bank equity, so my idea is that banks, when you pay interest to a bank, you're putting cash into the bank that the bank can then spend. It's a fairly simple vision of money. Money is the accounts of the banking sector and the accounts of the non-banking sector. So we have deposits and bank equity there, and I add them together, and the sum of those two is the money supply. So let's just do that. And then hit stop and run again. I'll start with 0, which of course will give me a 0 GDP. And then as spending occurs, you get a rising amount of money and a rising amount of GDP. And the amount of money, which is at the moment the sum of these 2 accounts, deposit accounts plus bank equity, is exactly equal to the assets that are being created at the same time. So if a government spends more than it takes back in taxation, it creates money in the bank accounts of the private sector, and it creates a reserve, an asset called reserve, which is effectively money in the bank account of the banking sector at the central bank. And I can bring that in right at the stage of, if I want to just make the model more complete, then I can create an extra godly table and make this the central bank. And then if I now model what's going on inside here, then what was an asset for the banking sector, which are reserves, are a liability for the central bank. So there are reserves. And I've got spending and taxation turning up. Where are they coming from? Well, they're coming from the Treasury. So if I now create the Treasury as a bank account of the Treasury at the central bank, then spending reduces the money in the Treasury's bank account, and taxation increases the money in the Treasury's bank account. So now the spending has been financed by Treasury. So let's go look at Treasury as well. Bring in one more bank icon here. Call this one Treasury. And if I now take a look at its table, then what was the liability for the central bank is now an asset for the Treasury. There are no liabilities so far. So I'm just going to type Treasury equity. What's the Treasury equity? And equity in this model means your claims on somebody else. I'm looking at things which are assets which are a claim on another entity in the system. So I'm not looking at things people own outright and might value independently of any obligations they have. This is your assets as claims on other people, your liabilities as other people's claims on you. And in this case, the spending, of course, reduces the equity of the Treasury while taxation increases the equity of the Treasury. So now we've got spend minus tax defining the Treasury's equity, and if the Treasury spends more than it gets back in taxation, then there is people have more claims on Treasury than Treasury has on them. And of course, this is the idea of a sovereign currency. It's creating liabilities for itself that enable transactions to occur in the private sector. So now we have almost a complete view. We've just left the public out. Let's bring the public in here as well. So this is the public. And now I look at their assets, and their assets are the deposit accounts at the private banks. They haven't got any liabilities yet either. So the public equity, we now want to balance this out. The public equity is the opposite of the equity of the Treasury. So government spending increases the equity of the public sector, and taxation reduces it. So the equity of the public is the opposite of the equity of the Treasury. If the Treasury gets positive claims on the rest of society, it ends up with the rest of society having negative claims, negative net worth itself. I'll just change this so I can actually see the tables on the canvas at one time, rather than having to go and take a look at them in a pop-up window here. So this will get a bit crowded, but I hope it's easier to understand when you see the whole thing on screen at once. So there's the public and the Treasury and the central bank. I'll just bring the central bank over here, and notice the help system didn't want that. This is clicking here is bringing up the right menu, the right menu on Minsky, and it's very sensitive to when you release the mouse button. If you move a bit and release it on the wrong variable, you get edit rather than change the display of the models. There's central bank, Treasury, and notice you get tax minus spend is the equity of the Treasury, and spend minus tax is the equity of the public. So the spending, if the government runs a surplus, and I'll just bring this over so I can make them a bit larger in one screen, and then run the simulation at this stage. So government spending creates positive equity for the public, and it's exactly equal to the negative equity for the Treasury, and that negative equity is equal to the creation of reserves that's going on at the same time. So the government spending is creating money for the private non-bank sector and reserve assets for the banking sector. Now, if you then decide, well, there's too much government debt there, so let's have let's tax it a bit, you stop the creation of money and you cause GDP to flatline. And then if you tax more, you run a surplus, you actually take money out of the private sector. So that's the basic point that MMT makes. One of the many basic points it makes about how the monetary system functions differently than the way textbooks argue. So that's the start of the whole thing. Let's just, I'll bring this one down and put this in editor mode as well. This is the banking system itself. And now what I want to add is, well, this is just having government spending. How does it finance it, so-called? Well, let's say it sells bonds, and I can bring up the table for the banking sector here and add an extra row and have Treasury bond sales. And the Treasury sells the bonds in the first instance to what we call primary dealers, or they're members of their banks and other financial institutions. So I need to, if you sell the bonds, how are the banks going to pay for it? They're going to pay for it with money created by the deficit itself, or reserves created by the deficit. So running the deficit has created reserves. And in the standard functioning system, reserves paid no interest. And of course, you can't trade reserves. You can't trade your accounts at the central bank. So what the Treasury does is offer to sell bonds, and that means that the bonds can become an asset of the banking sector. And so bonds here I could be more elaborate and have other groups other than the banking sector owning bonds, but I'll just leave it at the banking sector in this simple illustration. So what you now want to have is, let's say, call it T-bonds, with them to stand for Treasury bonds. So that's the sales. You're selling T-bonds. And of course, to buy it, then you've got to have minus T-bonds over here. So what the banking sector uses to buy the bonds that are being offered by the Treasury are reserves that were created by the deficit the Treasury also ran. This is another essential point in MMT, that the money that's needed, the finance that is needed to buy government debt is created by the deficit itself. That's why you've never had a currency issuing government have an issue of bonds which wasn't not just merely subscribed but oversubscribed, because it's an offer to convert the form of the asset that's been created by the banking sector out of the deficit from one which doesn't earn interest and can't be traded into one that does earn interest and can be traded. And that's the major encouragement for buying these T-bonds. So I've now got Treasury bonds inside there, and I now need to have that variable, stock in the system. So I'm going to take a copy of all the stock variables here and just grab bonds. And of course, once you're paying, once you've got bonds, you've got to pay interest on the bonds. So I'm going to assume there's an interest rate on bonds. I'm going to leave the possibility of interest on loans as well, of course, and make this a parameter, which say give it a value of 3%, with a maximum of say 20%, which is about as high as bond yields have got in America, minimum of minus 0.01 because they have turned negative on occasions, and a step size of 1%. And that means I can now vary the interest rate on bonds if I want to during a simulation. Now, if I now multiply the interest rate on bonds by the bonds owned by the banking sector, multiply the two together, then I now have the interest on bonds. So I just type INT here and then underscore curly bracket bonds, which lets me make subscript interest on bonds to make it separate from interest on loans. And now I've defined interest payments, and I can now include interest payments down here as something that the central bank or the Treasury does now that it's got the bonds out there which it has to pay interest on. So interest on bonds here. And that increases the equity of the banking sector. And of course it does so by increasing their reserves. The money's paid into their reserve accounts at the central bank. So that's now a reasonably complete model of what's going on. And let's take a look and see what hasn't been properly defined as yet. So here's interest on bonds hasn't been defined, and the T-bonds haven't been allocated to what's the matching account of the Treasury. Selling Treasury bonds has reduced reserves. That's fallen, but it's given money to Treasury, so that money turns up in the Treasury account, whereas paying interest on those bonds reduces the amount of money in the Treasury's account. So that's now completed how it's looked at from the central bank. And we've now got to go to the Treasury and see what's going on there. And with the Treasury, the sale of the Treasury bonds increases the equity of the Treasury, and the paying of interest reduces it. So now I've got a reasonable picture of a curly bracket there, so it's now correct. So it's now an integrated view of a financial system starting from zero. So I go back and reset the system. We're starting with there's no reserves, no bonds, no deposits, and no bank equity. We now have interest on bonds being paid, and that is going to turn up, as you'll see, in bank equity. So if I now just simulate the system here and run it, at the moment nothing turns up anywhere, but if we now have spending, pardon, that was taxation I increased there, let's go back and start again. There's spending, and what have I not done properly? I haven't had any sale of bonds. So I've got the bonds being issued here, but I haven't defined what the T-bonds are based on. And the simple thing to do there is say that the sale of new bonds is copying all the flow variables here. There's T-bonds. T-bonds are sold equal to the deficit that's been created. So let's now run this system and see what we get. And now we're getting reserves being created for the banking sector by interest on the bonds, with interest going to the banking sector. And the amount of reserves over here, the equity here is equal to the reserves that are being created over here. And then because the deficit is being not financed, but backed by selling Treasury bonds, the bonds are equivalent to the deposits. So what we have, when we run the system for a bit longer, we are creating a monetary system from scratch, where the spending is creating reserves for the banking sector, deposits for the non-bank, and equity for the banking sector, that equity being something which can then enable the banking sector to lend itself. Now, if I now go into having taxation being applied, notice that I don't get a total drop or flatline in GDP, because the interest on bonds, the bonds still exist, the interest is still being paid, and the result of that is bank equity is rising while deposits are remaining constant. So if you have a period of austerity where the government tries to tax more than it spends, for a while there's still money creation going on with the banking sector, because it still has bonds that are earning interest. That's going to fall as the bonds are paid off. But what the bond interest actually does is create equity for the banking sector. So you can actually kickstart your economy from zero by the government spending more than it gets back in taxation, creating deposits for the public when it does that, creating reserves as well, enabling the banks to buy bonds with those reserves, and then the interest on those bonds creates equity for the banking sector, which will enable the banking sector to have the positive equity that it needs to have to be able to lend to the private non-bank sector. So that is, in a nutshell, a very fast construction of how a monetary system could be started from nothing, money from nothing. I'm not going to finish the rest of the line, doesn't quite apply here. But that's the essence of a monetary system. So a fiat money system creates the equity for the non-bank public by running a deficit, and creates the interest that enables creates the equity for the banking sector that enables it to function by interest on bonds, which are purchased using the reserves that the deficit itself created. Now, the one thing I haven't got here at the moment is how does the Treasury actually pay that interest? You can see Treasuries, some over here is turning up as negative 36. And what is often required, that is effectively like the Treasury running an overdraft at the central bank. So I can say instead, well, rather than running an overdraft, it borrows from the central bank. So we have borrow from central bank, and that's going to give you a liability, which is loans, pardon me, by the central bank to Treasury. So I'm going to type, if I have now, that means that you have, I'll just type lend to Treasury here. That's increasing your liabilities. I keep on clicking in by the way, if you ever see these columns disappearing when you're working in Minsky's, because you've done what I've done, clicking inadvertently in the slide bar down here to move the display sideways. So that's what was going on there. So now the increase in the liability of loans creates a new asset as well, or not an asset. This is looking at the central bank's point of view. So it's got a new liability, the loan, that then tops up the asset. And if I now take a copy of that from the Treasury's table down here, so copy the flow variables, and what I want to grab hold of is the lending by lending to the Treasury. The simplest case to argue is that the Treasury bonds, or rather the interest on the bonds, pardon me, to delete that, the interest on the bonds is paid for by borrowing from the central bank. And now if you do that, the central bank, either the central bank doesn't charge the Treasury any interest because the central bank is owned by the Treasury, or in some countries it does charge interest, and then it gets paid back to the owner of the central bank pays its profits back to its owner at the end of the year, its owner being the Treasury. So effectively, the Treasury is borrowing at no cost from its central bank to finance the interest payments. And then when you do that, and now see what happens with your monetary system, let's go back and start with 0 and 0 for spending and taxation. So now I have spending going on. And what you have for the Treasury, its account remains at 0. The central bank, you could have a positive requirement there as well. This is just the simplest way to illustrate it. It's getting negative equity from its spending, and that negative equity is turning up as positive equity for the public in terms of spend minus tax, and positive equity for the banking sector in terms of the interest on bonds. And this is now a monetary economy growing out of nothing. And I could get more elaborate than this, and I will for a later model, but it's the easiest way to show with a very simple model. I know I built it too quickly, but it's still a very simple model, that government spending more than it gets back in taxation, it was what creates the monetary resources that enable the private sector to expand economic activity. And that's what's going on over here. Without the money, you would still be in a non-monetary economy. I won't call it a barter economy because such things don't exist. They're just in neoclassical models and almost nowhere else. But this is the vision of how the government's creation of a fiat currency enables a monetary economy to come about.